So what is the FICA Tip Credit? What we're going to talk about is understanding what it is and work on how to effectively communicate the value of it to restaurant and bar owners. Restaurant and bar owners have the most money sitting there waiting to simply be reclaimed. There are other industries, but we're going to talk about restaurants and bars today. So why does this matter? This is found money for business owners, a direct cash refund, not just a deduction. So this is actual cash that they have paid out because they paid taxes on the FICA tax due to a long-standing established law. This law was established over 30 years ago. It's not part of COVID. It's not part of the CARE Act. This money is owed back to them, no questions, and it's not a highly contested tax credit. This is well-established, no glitches, right? So very, very important. It's found money, direct cash refund. It will immediately go back in their pocket, being processed really quickly. And then there's a risk-free recovery process, right? So what is the FICA Tip Credit? So it's a federal tax credit, information documented at the IRS Section 45B, which reimburses employees for Social Security and Medicare taxes paid on employee tips. When you are at a restaurant and you add $20 or 20% to a ticket, especially if you do it on a credit card, right? The restaurant receives that money, the bar receives that money, calculates it as income for the server, and has to pay the Social Security and Medicaid federal taxes on that income. They have to pay their side of it, just like on any other penny paid to an employee. And that's really important because that was not money that ever belonged to the restaurant. That is a pass-through. So remember that, because that is what the credit adjusts for, is that this was not money that was ever owned by the restaurant. So it was established in 1993 under the Clinton administration to encourage accurate tip reporting. And the concept turns a mandatory tax expense into a refundable asset. They have to pay the taxes or claim the credit. And if they haven't claimed the credit, then they have paid the taxes. So they are owed a refund. So here's the problem. They are overpaying their payroll taxes, that Social Security and Medicare portion of the employer taxes that they have to pay. They're paying it on the tips. That's an overpayment. Restaurants pay 7.65% FICA tax on all employee tips. And for busy venues, most of the time, like the goal of a server is that your tips exceed your hourly wages. This effectively doubles the tax burden. CPAs and the owners are missing this. They just go through the books, right? Usually there's a payroll service company that handles paying the paychecks and calculating the Social Security, Medicaid, federal, and income taxes. And then that payroll company simply communicates the final calculations to the CPAs, and the CPAs take it as an expense against the income of the restaurant, and then they just file. And this is kind of a no man's land gray area. The payroll company doesn't care that the restaurant is paying this FICA tax, and the CPAs are taking the information straight from the payroll company. In most cases, this is why this is such a huge win. So does everybody see what I'm saying? How like there's two absolutely legitimate, correct, well-meaning, doing their great job hands in this accounting system for the restaurant. There's payroll company that's handling the usually minimum wage for servers, and then the reported tax tips, and they're calculating the tax on that, and they're simply handing over the numbers. Oh, this is how much Social Security and Medicare you've paid on what you paid your employees, period, done. And then the CPA takes it, but we get to step in and say, hey, nobody did a bad job here, but you missed this, and now we can help. The IRS realized that this is an overpayment. The tips never belonged to the restaurant. It was simply a pass-through. So they created the IRS Section 45B credit. That is the FICA tax credit in layman's terms. Any taxes paid on tips above the minimum wage of $5.15 an hour gets a tax credit back. The math comes down to 7.65% of qualified tips equals the tax credit. So on $100,000 in qualified tips, meaning the restaurant passed through $100,000 straight to their employees. People added $100,000 at the bottom of their receipts or reported cash income, and the restaurant paid the FICA, Social Security, Medicare taxes, $100,000. They are going to get back a check for $7,650. So credit versus deduction, the crucial distinction. So a deduction lowers taxable income. So a $10,000 deduction has a $2,500 savings estimate on a 25% tax bracket. But a credit is a dollar for dollar reduction. On one hand, you are reducing the amount of money that you are charged taxes on. So you are paying the same percentage on a lower number, which is great. Everybody loves deduction, but a credit gives you the full dollar amount back, not a percentage on a reduced amount. So the impact is greater, larger numbers, bigger checks. All right. We love a credit. We like a deduction. We love a credit, right? Credits are significantly more valuable than deductions. This is a direct cash back. So who qualifies? Primary industries are the full service restaurants, bars and nightclubs, coffee shops, food delivery service, hotels and resorts. The criteria of a qualification, so say you have a friend who runs a hotel and yes, people can tip through the service. Absolutely, we can still help you. But we want you to focus on the full service restaurants, bars and nightclubs. So you have to have employees that receive tips. Tips must be reported for payroll purposes. If you don't pay taxes on it, you can't get a credit or refund on it. That's just how this works. And tips must exceed the federal minimum wage threshold. So we also have a retroactive opportunity. This isn't just going to help you this year and future years. It's not too late. If you've been open for over 3 years, we can help with the amended returns for up to 3 years. So those credits, that's where the checks come in. So it's not just saving money this year by applying a credit before you write the check to your taxes this year. You're also able to claim checks back from the previous 3 years. This math is really easy. It increases the benefit to the restaurant exponentially, and introducing it to them rolling forward is a huge benefit also. So why do owners miss it? Payroll companies often don't calculate it. It requires specific data tracking, and payroll companies are really just doing their assembly line factory work. You tell me what you paid. I know your tax rate. We cut the check. We charge you the money. It's very cut and dry, payroll companies. My accountant handled it as a very common misconception. People assume that their CPAs are proactively researching and applying every credit for their business. I have learned personally the hard way that they don't. Tax law is incredibly complex. Most CPAs have many, many clients. Most CPAs don't know every single credit that applies to every single industry for all of their clients, unfortunately. We live in an unperfect world. The thought process of my accountant handled it, the reality is most CPAs just take the standard deduction, leaving money on the table. And when you have a payroll company that handles that aspect of it, you just plug in the numbers and keep it rocking and rolling. This is a statutory credit, not a loophole. This is not a special program. There is no upfront cost. The customer pays nothing until they are confirmed to qualify for the refund. This year's credit can be applied to this year's taxes if they haven't already filed yet. So there is an immediate benefit, and a check doesn't come, right? You just pay less when you file your taxes. And then there's a deferred program for previous years. Also, there's zero financial risk. If you don't qualify for the credit, there is no cost, period. We have US-based CPAs. All of our operations are American-based. I'm involved with setting up the structure and the document collection and the fraud prevention and know your business, know your client, KYB, KYC. That's all my scope. So I can attest. The client simply provides basic data. We need 4 documents. We have a team of field agents, account executives, processors, QA, QC, CPAs, everything. But what we work with the client, while we make contact with the business owner so that we have authority to work on their behalf, we will go so far. We will talk to the payroll company. The processors will work with the accounts payable department, who, however the business owner wants to hand this off to the right person, we will work with them to get the documents. That we have an internal team that pulls the articles of incorporation, that verifies everything with the Secretary of State. Like, we do all the legwork to make it really as easy and seamless as possible for the business owner, the restaurant, the bar owner, etc. Really, we just want them to sit back and get their money. This is a well-established, standardized program. Isn't Trump trying to eliminate taxes on tips? And the answer is yes, but that is an income-based tax, an income tax paid by the server. Okay, that's different. The server pays income tax on the money paid by the restaurant and reported by the payroll company and the restaurant. So the business owner is paying the employee, the server. Let's say their W-2 says that they made $80,000 that year, and that is payroll, wage, usually minimum wage, and all of the reported tips. So the employee, the server, gets their W-2 and says, oh, I made $80,000. I have to pay income tax on $80,000. On that W-2, it's broken out. How much was wage, how much was tip? And it shows how much was paid, how much was withheld from your income for FICA, federal income tax, state income tax, Social Security, Medicare. The employee pays taxes based on that information, That is their income tax. If Trump eliminates paying tax on that, what the employee made, then when they report that they made X amount of tips, they will pay less income tax. Regardless of what the employee pays in taxes on their income, the employer has still paid the FICA tax on their filing. The FICA tax credit benefits the employer, both very deserving programs, both great news, and one does not affect the other. Very likely that you have overpaid your taxes because of the way the IRS has structured filing. It is complex. Nobody let you down. No mismanagement from your payroll company, no mismanagement from your CPAs. Through nobody's fault, probably have simply overpaid on this one factor, and we are specialists that are able to evaluate if you have, no cost for us to check, and if you have overpaid, we can talk to you about getting that credit, which is a true cash back, check in hand benefit for the past 3 years, an immediate benefit this year so you can pay less, and you only pay a fee if you do qualify for that credit, if you have previously overpaid.